Welcome to the Money Vikings podcast, where we conquer financial freedom. Join Greg, Jerry, and Bob as they discuss everything investing and personal finance. The Money Vikings podcast is hosted by three dads who are doing what they can each day to burn down debt and build wealth. Learn the path to true wealth. Their podcast and website, moneyvikings.com, is a treasure trove of ideas. So without further ado, here they are, the Money Vikings.
Financial independence, retirement, what's the difference? And are they even possible for a majority of people? Let's conquer financial freedom like Neo in Matrix Resurrections in theaters this Christmas. Welcome to the Money Vikings podcast number 53. Bob, Jerry, have you seen the trailer?
Yes, I have.
Oh, no, I have not.
Did you just turn this into a commercial for the Matrix?
I will turn every single one of our shows from this point forward into a commercial for the Matrix.
Dude, Jerry, it's good.
Yeah.
It's good.
Okay.
It is. It revives some deep-seated Neo memories.
I mean,
wow.
It's good.
Guys, it's been 18 years. You want to feel old? It's been 18 years since the last one was made.
Greg, why do you have to go there? Why did you do that to me?
It's so messed
Why
up.
did you have to do that to
That
me?
is so messed up.
I know.
I hate when, don't you guys hate, like, I don't know, I'm getting to that age where there's like stuff happening where it's just like, oh yeah, that was 20 years ago. And I'm like, no, it wasn't. What? What are you talking about?
Yeah,
Anyway.
I was just getting my driver's license back then.
Oh yeah, there you go. You were 16.
I just got my AARP card back then.
No, it is cool. But hey, the reason I bring up, there is a connection here to my randomness here with my intros. So we're doing a whole show here about we're going to do a lot of stuff with the news and what's going on with trading and the market. But today we're going to do a deep dive on the history of retirement. And it's quite a fascinating story because I guess back in the olden days, like, I don't know, like 80 years ago and before, there was a thing called retirement, and it was basically the day you died. So like you worked your whole life and then you died, and then they were all, well, you're retired now. So I don't know if you guys are aware of that.
That's how it was. Well, I talked to my dentist, and I asked him when he's going to retire, and he's like, oh, most dentists just die.
Did he really say that?
Yeah. He said that to me like,
Interesting.
Years ago. Yeah.
Wow. Is that because it's like like they enjoy the job so much, like rooting around in people's mouths, or what? Or is it one of these things where
let's go with that. Let's go with that.
Yeah, sounds good.
Okay. I don't know. It seems like dentists make pretty good money, but maybe I'm out of touch here. Okay, here's the connection. To me, cracking the code of retirement and financial independence. This is one of the big things about why we do the Money Vikings, is cracking the code of the Matrix. And I'm being serious about this. It is not easy to crack the code on retirement in this country and financial independence. And you really need to see the code. Bob sees the code when he's doing his charting. That's all Bob sees. He's Neo.
And that's all it is. It's all applied to my face.
Sees green code. All right.
Because people don't. I mean, it's. We've talked about this a lot on our shows where it's you're made to think that you're a worker bee. You go to the job and you put in the numbers, or you do the manual work, and it's the production line stuff. And then you do that for so many years, and then at that point you've earned your right to retire. And
it's not enough anymore.
It's not enough.
It's not enough. I mean, it never was enough for a lot of people, and we'll get into that, and that's the crazy part of it. But that's why we're here. We are coaches to support people on a path to building wealth. Every week we are engaged with our members, delivering ideas and inspiration. I'll just say TMV listen, right?
What?
I think that's the code. So
if
you want to join Money Vikings Premium, you get a discount for being a podcast listener. TMV listen. I think it's all caps.
Mm-hmm.
Nice.
Caps.
So there you go.
Good deal.
Gentlemen, we got to do news. I just have to say, Tesla delivered a record-breaking 241,300 cars in the third quarter.
Yep.
That sounds good.
This is why.
Jerry's barely impressed.
Yeah.
He's like, okay,
that suffices.
I guess I'm good with all of your groundbreaking things, Mr. Musk. So, maybe you could really raise the bar next time.
Yeah, maybe you can make the stock go above 1,000.
Hey.
Jeez. Wow. This guy is so hardcore.
Dude. How about this? If you do the reverse split, it would be way over 1,000.
It would have been probably
That's
like.
not what I'm talking about.
Yeah, that's what I'm talking about. You're welcome.
Well, Kathy still thinks it's going to 3,000, but
Nice. It'll meet Chipotle someday soon.
it'll meet Chipotle. Chipotle always trips me out. I go to
Jerry's hurting my heart right now.
Well, I
Really
go to
bad.
Chipotle and I think about that stock price, and I'm always like, what's going on here? I mean, this is a great
Really?
place. I love this place. I'm like, the place is great. This is wonderful food. But I'm like, wow, it's $3,000 a share. Do they have like 7 shares out? Like, anyway.
Why?
I got to tell you a quick Tesla story, though, guys. This is my story about sticking sometimes to your convictions if you've really put the effort into the research. Okay, this was 4 years ago. I had some people that I respected, investment-wise, that told me, get out of Tesla, don't invest in Tesla, buy some GM. Nothing against GM, great thing. But I don't know, sometimes you got to take the risk. So I listened to them and I didn't. After they told me this, I had made some money in Tesla. I sold half the shares, but I kept the other half, thank God. But I should have kept them all.
Yeah, I think as people get caught in on that hype, right? Or somebody somewhere, their trusted source is telling them to do something, and it's not. Yeah, doesn't pan out.
I understand managing risk, but I got to tell you, over the years, it's hard. It's hard to bet against Elon. I don't know what to tell you. I know there's Elon haters, but I'm not one of them.
I'm not either. I'm
not an Elon hater. It's hard. The guy is, I don't know. The guy makes us dream again. I think it's pretty cool.
Yeah. Absolutely.
Okay, in the news, don't be this guy. Recent study. We do a lot about the psychology of investing because I think that's just as important. Getting the psychological game down is just as important as the mechanics of everything.
Absolutely.
Recent study indicates that married men with children over 45, I know a few, are typically the ones who panic sell in a stock market dip.
Really? Al Bundy's.
That's right, Al Bundy's.
All Bundys, man. They panic sell. Don't be that guy.
Don't be that guy.
That's all I can tell you.
It's funny you talk about the psychology because if people kind of venture into Netflix and they watch some of the shows that we talk about, right? There's one that I think it's gambling. It talks about gambling. What's the name of the shows we were just talking about?
Explained. That's what we're going to go into. Yeah.
Gambling.
They're great.
And one was about like gambling or something like that. And it talks about how casinos set up to win, right? Where there used to be this model that would drive people away and they would lose their clientele, right? But they changed it to where people would lose on a steady pace, and then they would have one big win, but that big win would not make them whole. And so that big win would get the adrenaline going, the endorphins, churning out. Dopamine. And then they would go on a losing streak again. Then they would get another big win, and then another big win would not even bring them to their second, that second level.
Being played like a fiddle.
So I mentioned this because it is the exact same tactic that is now introduced in the stock market. And so people need to understand that there are computers and things out there that know this, and they will manipulate price on a downtrend, and people start averaging, they spike, but you'll never get up to that level you were at.
Mind blown, red pill, blue pill.
You welcome.
Matrix, thank you, sir. Mr. Anderson. That was crazy, Anderson. Bob. You're kidding.
Yeah, no, that's
wow.
What they're doing.
What I've heard about that too, and it's kind of a framework for addiction if you want to cause it, is that they win just enough to come back and gamble again.
Yeah,
it's sad.
Age of the retail investor. They found the new tactic.
Got to ask ourselves how we are manipulated.
All right.
Jerry, what do you got here about the SPY correlation? You want to share that with us?
Yeah, I just thought it's not really a news item, but it's just a thought that I had as we're kind of going through some downtrends and some volatility. We kind of get stuck in our heads that the SPY is the market, and that's not always the case. There are, as Kramer likes to say, there's always a bull market somewhere, right? So even if SPY is having its issues and it's volatile, it's going down, it's going up, there are some other things out there that have very low correlation with SPY, and that's kind of one of the reasons we diversify. So there's commodities, for example, which some people look at as an inflation hedge, And as inflation seems to rise, the price of commodities seems to go up as well. So DBC, I believe it's an Invesco ETF that tracks oil and many of the
Corn.
Corn. There's DBA, one of my favorites as
You
well,
and corn.
for agriculture.
Corn and soy, man.
Corn and soy, all of those, they're great. They're great. You guys laugh, but they're not correlated with SPY as much as something like the Russell 2000, which we did a trade on this week. So my point is just kind of keep an eye in Tastyworks. It's very easy to look at any sort of underlying, and it'll give you a number between 0 and 100, or actually -1 and +1 for correlation. And just to review, 1 is a perfect correlation, 0 is non-correlated, and -1 is a perfect inverse correlation. So maybe UVXY and SPY. SPY goes up, UVXY goes down. SPY goes down, UVXY goes up. It's not a perfect -1 correlation, but these are all things you should know, because if you want to manage a smooth P&L for your portfolio and sort of get these huge spikes and declines off every day and just kind of slowly go up and protect, you want to pay attention to SPY correlation and look at things that are either inversely related or low correlation when adding things to your portfolio. It's just a data point. You can Google any ETF or stock and its correlation with SPY to kind of see where it stands and see where your entire portfolio is weighted. I try to make my portfolio completely neutral with SPY as much as possible.
Jerry, we chuckle at our own peril, and I got to throw you a bone. That's probably one of the most important things we'll say on the show today, because I think you're absolutely right. When I look out there, and I think you guys are doing the same thing, I mean, assets are highly valued. We've been saying this for a while now, okay? People are real caught up in FOMO or something, and there's a lot of very highly priced assets out there, and it just seems ripe for a correction. And we are sort of seeing this every week, right? Every week it seems like Monday we get some sort of jolt or jitters. So yeah, I think that diversification with something that's uncorrelated is pretty key right now, because a lot of people have portfolios that are constructed to do just fine when the market's going up, but when things get choppy, their portfolios are not constructed to handle it well at all.
Yeah.
So I mean, it's one thing if you can sit there and just not look at it and not worry about it, you'll probably be fine over the long run.
True.
But if there's like an over 45-year-old that has kids and he freaks out, then he's in trouble.
I don't know any. I wish I could dump this knowledge on them.
I'm getting close to knowing one.
Love it. I love it.
No, that's great. That's good.
I think it's also important when people need to take consideration, speaking kind of to the newer traders or investors out there, is that knowing about seasonality and market cycles. Because that's the big thing is, diversifying, but also understanding market cycles is really important to anticipate maybe where you're going to maybe hurt a little more in your portfolio at certain times.
I mean, you're absolutely right, Bob. And for the most part, you look at the S&P, for example, over the last, 80, 90 years, whatever, and it just continually went up if you look at it that broadly, okay? Right. But there were a bunch of dips in there and really bad years. And I've heard that if you miss like certain windows,
key days,
right? If you miss, you guys have heard this. If you miss certain key days, so example, if that over 45-year-old sells the day after everything tanked because he panicked, that's basically the worst time to sell because they take such a huge loss. It takes like decades to get out of that. Doesn't mean that someone's like retirement is shot, but it's just sort of an interesting thing to keep in mind if you want to like keep ahead of inflation and stuff. So it's the
agreed. I mean, and just to kind of pull this home, tie a bow around it. We always talk about diversification and the kind of the grandfather overview is always like a 65% stocks or 70% stocks, 30% bonds. Why do we say that? Why do people say that? Because of the low correlation between the two.
Got it.
But here's the thing: is over the years, because of the housing market crash that occurred, I thought it changed bonds.
Meaning it's more correlated with the market than it was in the...
Yeah, because
bonds just haven't done. I mean, bonds just haven't done very well for quite a while. But I don't know. It depends. Bob, okay, I'm gonna skip to a news item because you just hit on it, and dude, you're gonna lose your mind when I tell you this.
Okay.
You are ready? Are you ready? Are you sitting down?
I don't know if I am. Let me hold on to the handles of this.
Are you sitting down?
Hold on. If it's what I think you're going to talk about,
okay.
Hey, Bob.
Let me put a helmet on.
Housing and real estate is about to come down over the next couple of years, dude.
What? What?
No, okay.
You heard it here first.
So I always follow this guy. His name's Schiller. I'm sure you guys are familiar with him. Professor Schiller out of Yale. His famous index is the Case-Shiller Index, which you hear about, which tracks housing.
Oh, that's Schiller.
Yeah, that's the Schiller.
Yeah.
That's the Schiller.
Yeah.
Okay.
Right.
He is, he's really interesting to listen to because he is a real estate expert. He's an economist. And he's kind of notorious for throwing cold water on real estate as kind of an investment, because he basically says, like, your house, for example, I think he says, like, over the long run, your house kind of like barely keeps up with inflation. It's just a consumable. He doesn't see it as this big, broad investment that everybody likes to talk about. Now, that can be heavily debated because in America, most of their assets, if they own a home, get actually tied up in that home. We can talk about whether that's good or not, but he just says from a pure asset class investment, it really doesn't do that well over the long run in most markets. Now, there's particular markets, we live in one of them, and there's others that I think are different because markets are different with real estate. But anyway, he said, Bob, that he thinks this thing is peaking. And he said that what's been driving everything up to this point is clearly the low interest rates. And he also says there's a huge amount of FOMO. There's a huge amount of fear of missing out that's going on. There's a speculative period in everything. And he says it's going with housing too. He says everybody just thinks, and he said that there's a psychological thing going on where people during this pandemic have felt like they just need to do something. And he said one of the things they've done is they've traded up into other houses or they've bought a house.
Yeah, because everybody's, when you get into the lockdown, you're sitting around, you can only twiddle your thumb so much, but it's absolutely right, because what's going to happen is you have the talk around the stock market doing its thing soon, right? Then you have the talk around the housing market, the next bubble, and so I think people psychologically, it's that visceral reaction that it's going to be like the house crash, and they are reactive. And they're like, I'm not going to let them give me this time, and so they're selling their house, and so that's going to flood into the market, and it's going to flood into the inventory. So
here's my prediction this time, Bob, though, which I think you'll disagree with me. I think it's going to be a soft landing this time. I don't think it's going to be a hard landing. Yeah, it'll be like a softening, and then things will kind of like next year. Maybe nationwide, it'll come down like 1 or 2%, and then maybe another 1 or 2, and then it'll kind of like go sideways for a while. I don't know. That's my. It's gonna be like and that's based on nothing. That's based on no data. Yeah. So there you go.
It's gonna be like a wiffle ball bat to the face instead of like a Louisville Slugger, is what it's gonna be like.
Well, 2006, 7, 8 was a Louisville Slugger. Yeah. So.
My indicator is I'll go for a walk around my neighborhood and count how many homes are for sale.
What neighborhood do you live in? Where we
I mean,
there's a lot.
You might be on. You actually might be onto something.
No, it is a good
because it is about supply and demand. And if there's a ton of supply going up, then it's going to soften the. I mean, people are going to have more options, right? They're going to be like, oh, I don't have to do a bidding war on this house. I've got 3 others down the street I can look at.
Right. Yeah. Let's call it. Let's create our own index. It'll be the Texas Index.
I love it.
So what I think we should do is build a flying fortress with our homes on it, and then that will always retain its value.
Flying fort. Wow, my face right now. If you could see my face, I'm really puzzled by the imagery.
No. Okay. Now, but let it soak in. because that value will just always
fortress.
go up because nobody else will have it. We'll be the only ones, guys.
With a flying fortress?
Yeah, we'll be floating. We'll be floating above everybody.
I think you are Elon Musk. I don't know what the hell's going on here.
We'll scoff.
Okay, people, I'm sorry. I don't know. He's crazy.
He's smoking the good stuff today.
I would say. All right, guys, let's see. This is a good one that came out of our household this week. I really like this. I was talking with my wife about Facebook and kind of the kerfuffle, and really I'm very actually upset with Facebook over some of the stuff that's coming out about the studies that they show where it's like bad for kids and all that kind of stuff. I think it's pretty lame. But anyway, of them. But my wife said that we live in an age of information anarchy. And I thought that was really poignant. I'd never thought of it that way. But I think it also applies to investing. Jerry, you've said this. We at the Money Vikings in particular, we're trying to be less noise and more signal, right? Mm-hmm. Like we're trying to wade through the noise, right? Get the noise out of the way and focus down in on what is going to help someone. Right?
Yeah. Focus on the facts, focus on the data, let people come to their own decisions, but not be influenced by, the algorithms out there.
Yeah.
And that's one of the big things is just recently I mentioned to the premium members about how I want to really start diving in to helping everyone else, know what they're looking at in the market, like on the charts and whatnot. But also it's about knowing what other areas to look at to also help identify the areas of opportunity or the areas where they need to protect themselves and whatnot. So there's, we get so focused on these things and they don't realize that there's a whole other world of things out there that we need to be aware of and knowledgeable to. But then it's like, it's all the things outside of the stock market that we talk about, right? It's the
budgets, insurance,
credit card stuff, insurance,
living trusts, housing.
So we're going to start really getting into that stuff here soon. So I know the premium members are in for a good one.
Well, you're right, Bob, because someone can do the greatest swing trade, right? Right. But if their boat is leaking out the back, oh wow, I made $200,000 off this swing trade. Hey, that's really great. You're about $300,000 in debt over here. You got freaking.
You're close. You're close.
Yeah, I mean, you know what I'm saying?
Yeah.
I mean, okay, you dug yourself out of a hole a little bit more, but did you get ahead?
Oh, did you keep it?
And here's
did
the
you
thing.
Keep it?
And here's the other thing. People aren't realizing with them doing so many trades throughout the year, what if they're making money, what their taxes are going to look like. They need to understand that. People don't comprehend that. Hey, I'm doing that same $200,000 they made off of $1,000.
Yeah. Guess what? Guess where 50,000 of that goes?
Yeah, they're going to pay taxes on all those transactions.
No, you're right. You're right. It's a holistic. You got to look at everything. You got to pull out all the stops. Hey, that's what the show's about today. It's basically about financial independence and a brief history, an interesting history of our retirement system in this country. And so what inspired me, guys, is there's this show Explained. So I don't want to take credit for all this because I watched this show and I'm trying to share this with everyone. So go watch the show on Netflix. It's called Explained, and there's one about retirement in the US. But here's the thing. The sad reality is that our system in the US, and really for the world, I mean, if we don't have a good system, most people don't. I mean, we don't all get to live in Switzerland. But in the US, for most people, the system's broken.
Yeah.
And again, we go back to this. This is one of the main reasons we started Money Vikings. We have got to help each other achieve financial independence because no one else is going to help us.
Right.
But the crazy thing is that the system sucks now, but it sucked even more in the past. So before, like I said in the beginning of the show, during the Great Depression, Bob, half of U.S. seniors lived in abject poverty. I mean,
Really?
we can't even fathom this right now. But they literally did not have enough money to go buy their lunch that day. And so we have to remember that isn't that long ago. Our grandmother, right? Our grandparents were young. We're children at that time. We're maybe, 10, 9, they were kids. So, I mean, they kind of, a lot of them felt this in a way, probably. I don't know what kind of memories they have of it, but I'm sure there's people alive that have memories of it. right?
Well, yeah, and growing up, I mean, that shapes like me growing up in my family. It kind of shapes the whole way that my family sort of looked at money and thought about it. And it was a lot of saving. And it was a lot of even if they had the means to purchase things, it was that sort of shaped my view kind of growing up.
And so, Jerry, you can tie that actually, if you go back historically, you could tie that to some experiences that maybe your grandparents had, right, in the Great Depression.
Yes, absolutely.
Yeah. No, that stuff is fascinating. I mean, I find it interesting because this is the thing, we take for granted the world. We live in this world right now, and we're just trying to live our lives, and we're one person, but we take for granted that all of this was built before us and things were put into place to help us. And so that's what I'm going to talk about here. So the bottom line is, we're going to get to this, but today a person, they really say, has to save and invest at least $1 million to retire. So we'll get into that. But here's what happened. There was a guy in Long Beach, California. I don't know if you guys ever heard of this guy. His name was Francis Townsend. And I bet if you went on the street and asked everybody, who's Francis Townsend? I imagine almost no one could tell you who he was.
Right.
Could you?
The brother of the guy from The Who.
I didn't know this. Actually, Jerry, it's a different Francis Townsend I'm talking about.
Okay.
This guy.
Heard of Long Beach.
Okay, you've heard of Long Beach. Okay, that is a cool place. But here's the deal. He was actually pretty old even during the Depression. Okay, so he was in Long Beach in like the 20s or whatever. But his experience through the Depression had him come up with this idea. He's like, this is so bad. And he said, we're building so much wealth in this country. He's like, everyone in the U.S. over the age of 60 should have a guaranteed income from the government for the rest of their life. And again, before Townsend even came up with this idea, there was no concept like this. It was you worked, and then one day you died, and they're all, you retired.
Sounds like a socialist to me.
Okay, come on.
Kidding. Sorry.
So this is what happened. These things called Townsend Clubs popped up all over the country. And all over the country, people were going to these clubs and having these meetings, and they were discussing the merits of guaranteed income for those over 60. And this basically pushed FDR to sign into law the Social Security system. And so Social Security system was different than what Townsend imagined. Social Security was basically a smaller vision, but it was supposed to keep people out of abject poverty and allow them to eat. And it was basically funded by those working. So all of us who work pay into Social Security to pay for the older folks now. And then hopefully there'll be younger people working when we're older, and they'll be paying us. So let's get those young whippersnappers paying us pronto.
Dude,
okay.
Not when they're hodling to the moon. Yeah, I don't know. We'll see.
But here's the deal. So Social Security was supposed to be, and the vision for a while was this: it would be part of a three-legged stool. And basically you'd have a personal savings. Okay, so people would save as much as they could. They would then have Social Security, and then a lot of people at the time, this was the golden age of pensions. But not everybody had one. But if you were lucky enough, you had all three of these things, and you could basically take care of yourself, from 65 on. But then the 1980s dropped on our asses. Okay, sorry, I don't mean to. Okay, I shouldn't cuss on our show.
Is that really cussing?
Yeah, bleep that out. Okay, cool clothes and music, not cool retirement stuff. Okay. All right. Here's the deal. So basically, pensions and stuff started to get obliterated. And there's this guy named Ted Benna that comes around. In 1980, he's fed up with, he's an employer HR sort of guy, okay, at a company. And he's got employers coming in, and all they're interested in is getting tax breaks for themselves. And he's like, none of them cared about their employees. Wow. And so so he did this for years. And then he basically had this epiphany, and he decided I could either remain at this job as a workplace benefits consultant, or I can be a Christian. And he had a lot of faith, but he said I couldn't be both, is what he basically came to the conclusion of. So his faith went up against what he was doing at work, because he said, I wasn't helping people. I was not helping them. And so in 1980, he identified an obscure section of the tax code called the Section 401k.
Okay. Sounds familiar.
Yes, ready for 401k.
Mm-hmm, mm-hmm.
Now you know the history of your name, dude.
Yeah, you're welcome.
Let me tell you, son, how you were named.
Yeah.
Okay. Okay. So here's the deal. The Section 401k allowed employees to avoid being taxed for paying workers in the future. Okay. So in other words, it was funding future accounts, and it was a deferred benefits tax code thing. Okay. Long story short, I'm gonna fast forward here. He got all the right stars aligned. Somehow he had an in with the Reagan administration. He had somebody that was like, "Yeah, man, I'm pals with Reagan." Somebody at Reagan's staff. So he basically got into the Reagan administration, and he lobbied for this thing as something to help workers. And he help workers sock away money without it being initially taxed. And so the vision was that not everyone would pay completely for their retirement with a 401k plan. He had actually a broader vision of a retirement security. And so in the modern era, Mr. Benna actually calls the 401k a monster of his own creation.
I don't like him.
So he basically, so here's the deal. He it's a little tongue in cheek, but he calls it a failure because he said starting in the 80s, the whole focus became 401ks. And it was just, all the retirement security was pushed onto the worker. There was no expansion of federal benefits. There was no expansion of employer pensions or anything like that. They were just like, no, we'll put this money in an account. You put your money in, it'll go in the stock market, and you pay for your own retirement. You're on your own. And he said because of that, he said it was a failure. But I'll tell you why. He has a reason. Yeah, you'll see why. So as of today, I'll give you an example. A 55 to 64-year-old, the median balance in a 401k is $69,000. The average, the average is $197,000, and the average is skewed because a couple of people have like really high balances.
A lot.
Yeah. But most don't have that much. And so he basically is saying, if you're 60 years old and you have $100,000 in your 401k, and what are you're going to live another 35 years? How are you going to make that last?
Yeah.
Right.
Now, just to be clear, is that balance for a current job that they're in right now, or is that the summation of all of 401ks that some may be rolled into IRAs and others are active 401ks? Do you know?
No, that's a great question though, Jerry, because you're absolutely right. Because people notoriously leave these things all over the place, right? It's a mess. Like they leave jobs, they'll be at one job for 5 years. They take the next one for 10, and they've got like these random accounts, right?
Right.
So yeah, I don't know.
I'm going to read this as if when it says 401k, that it just kind of says, and prior 401ks from previous jobs all rolled together. That's how I'm going to think about it until we know otherwise.
Yeah. So the bottom line is it's not enough. And so it's not, and people are really struggling. So unless they are lucky enough to have a juicy pension, or they were really smart enough and disciplined enough from a young age to really sock the money in that 401k. I mean, here's the deal. You guys know this about life. A lot of times you're making decisions at 25 years old, 35 years old that are affecting your 85-year-old self that you can't even imagine.
Yeah.
Right?
Yeah.
So it's crazy.
We gotta be good to our future selves.
Yeah.
It's true.
So there you go.
Party on, Wayne.
And thank our past. Yeah. and thank our
good.
So the bottom line is that, as you guys realize, I mean, and this is what Money Vikings is all about. It's motivating people, coaching, life coaching, you can call it, financial coaching, to get people to $1 million or more, right? Because we have to get there. It's a core tenet of what we do. But here's the reality for most people. I mean, life is not a success-only journey, right? So, people have student loans, people have debts, people have medical emergencies, medical bills. I mean, there was a dude that got charged like $60,000 for a COVID test because of our healthcare system in Texas.
It's horrible. It's crazy.
Think about a person that has a lifetime of lower wages, or they're on and off jobs. I mean, I know people that are on and off jobs. I mean, they have maybe 5 or 6 good years. They get laid off. They got to spend a couple of years getting back on their feet. If that happens to you 3 or 4 times, you've gotten to the end of 40 years and this gets pretty tough.
Yeah.
So most people will have to rely on family. Many will have to rethink what retirement means, right? We talk about that a lot on our show. And what does retirement? I mean, Jerry, you've said before, that you don't really see yourself like retiring in a certain, because you like to do things, you like to make things, you like to engage in things. I mean, maybe that's changed over the last couple of weeks for you. Maybe you're ready to retire.
I'm ready, damn it. No, I'm going to do this Money Viking things forever.
Yeah.
Oh, hell yeah.
The multi-generational household is starting to come back. That was something that happened way back when, Dust Bowl time, right?
Right.
And it separated out, and it's more accepted in like the European and Asian cultures, and America has kind of gotten away from it, but it seems like we're starting to get back. There's a lot more multi-generational homes coming up.
I mean, I think you're onto something, Bob, and we have to be creative. I think we also have to be aware of the pitfalls that are ahead of us in the system. I mean, like I said, I mean, some people that don't have good medical coverage, insurance coverage, I mean, that can cause a lot of problems. We have a lot of people live, if you want to get quality jobs, traditionally you've had to live in high cost of living areas. I mean, so that kind of balances out there. Mm-hmm. I will mention this. I mean, we have a pretty cool article about it, but Roth 401ks. I mean, I think that's the unsung hero of retirement plans, right? And those I think are brilliant, right? Because you're paying the taxes up front.
Yeah.
And then in the future, when taxes are higher, right, you're withdrawing that money tax free. So that's another tool.
The thing that also people don't realize is that there are tactics with the Roth IRAs as well that does allow you to actually withdraw before you're retired.
There's the $10,000 first home purchase. At least that few years ago, that was one way to do it. I think medical, there's some provisions.
Yeah, there's provisions for medical, for home purchase. There's also provisions that allow you to withdraw your initial seed money, I guess, and we refer to it. Yeah, there's stuff like that. And so there's methods around that. And it's not to say that you should be doing that.
Right. We're not encouraging that.
Yeah, I don't encourage that. But just, people think, they hear about these Roth IRAs and the pre-tax dollars, and they think themselves that they can't touch it until they're 65. Not necessarily true, but you're also investing for that longer term picture. So.
Bob's going to buy a boat.
I'm on a boat. Dude, Catalina wine mixer, man. Yeah.
Well, there you go. The RV may qualify as a home.
It actually does. I'm glad you brought that up. So people do not understand this and do not know.
I don't know, guys. Yeah, van life. I don't know. I know it's a thing, but
here. So this is. I'm so happy that Jerry mentioned this. So, motor homes, RV homes, are actually seen as a secondary residence, and people can get like a 30-year loan on it, and at times they can actually appreciate in value over a period of time.
Be careful with this, though.
You do have to be very careful with it.
Be careful with this.
Greg thinks of them like cars.
For the most part, I do.
Because they have engines.
He just sees them as depreciating assets, which for the most part they probably are.
Right. So, Greg, I'm going to give you homework. I want you to read into this, and next show I want you to report back.
I'm a good student.
All yes. Right. So, but yeah, RVs like mobile home. I guess. Well, you don't want to say mobile home because those are a little different. But RVs and campers and whatnot, they actually can be categorized as a second home.
Brought to you by RVs R Us. A little tidbit of information for you. Yeah. Okay. Yeah, you do sound a little bit like the RV salesman. These are appreciating assets, just like a house.
It sounds so bad. I know.
I don't know. We'll
put a solar panel on top, get the tax credit.
Oh yeah. No, but the only reason why I say this is because for people that want to do traveling and whatnot,
and retire,
and
drive around the country. And I think the mortgage, you can deduct the all the interest just like you can on a standard home. So just these little tips and tricks.
There's one.
Tricks. These are tricks, you guys. You're welcome.
Man, I love lobbyists.
Greg's not going to be a believer until he's a believer. So we're gonna make sure.
It's true. See how long. Okay. Hey, Jerry, tell us about your dad. Some of his experiences with the things you heard from him, because I thought you were telling me earlier.
Well, he was in the Navy band. He no longer with us, God rest his soul. But he was in the Navy for several years when he was a young oboe player. And he just raved about the benefits. And growing up, every time I got jobs, he would ask me, what are the benefits? And he didn't mean salary. He meant, are you getting medical and dental and 401k, all that type of stuff. That was very valuable to him. And he got that from the Navy. He was really excited that he got, free haircuts and free, they gave him a new bridge for his teeth and root canals, whatever he needed, and that was really cool. And that was a huge benefit that, I think it was more recent, as you were saying, Greg, that the 401k and a lot of these benefits are more nowadays tied to your job. So you need to get a full-time job to take advantage of these things. But he was able to get that through the Navy. And just a big proponent of those benefits.
You're really onto something with that, because that stuff can't be underestimated, undercounted. And I've heard this debate recently with some criticism of the FIRE movement has been that, that's all nice for people that have good quality, I guess you would call it, jobs with all these benefits. But if you're an Uber driver or you're, you know what I mean? I mean, there's a lot of jobs where you do not have any of these benefits. You're on kind of like, you're like a contractor that they just bring in to do the work, but there's really not a connection or a real support system for those workers.
You got to buy it on the open market, and it's not cheap. Man. Have you ever been on Cobra? Even Cobra.
I have, in fact, and I have a very bad experience with Cobra when I was in between jobs about 20 years ago. Yes. And I was like, I think I had saved, my savings was like $3,000, and I needed to go on Cobra for 2 months between jobs. And I think it cost me like $1,500. And I remember being like, what the hell? I mean,
what people don't understand is that when you're on Cobra, you're actually paying what your employer's cost for the benefit was without their contribution. You're actually paying 100% of the benefit.
Right. And employers are now, go ahead, Bob.
I would say, so sometimes the better option is actually is to waive the Cobra coverage and actually go on individual coverage, because you can get discounts through, programs and stipends and whatnot. So people don't consider those little things.
The employers do pay a lot, and now my employer in more recent jobs, they make sure every employee knows how much they're spending out of pocket. Like, here's what we pay, here's what you pay. So just don't, and then they build that into the salary as if you're making that money too, and they're so generous. But
wow.
When I'm in between jobs, I remember this happened one weekend. Just a small side story. It was like a Friday I had finished at one company, and then on Monday I was supposed to start at the next company. And for that weekend, me and my family, we wrapped ourselves in bubble wrap and just stayed home.
Good move, buddy. Good move. Good move. Hopefully you ate some healthy food. You didn't develop heart disease either.
I think we lived on blueberries.
No. Oh, well, there you go. Check out our newsletter. That's awesome. That is awesome. Well, I wanted to share these stories because I just, we wanted to keep this brief kind of big overview history lesson, not some boring thing, but we want to it is interesting to see how we got to the world we're at. It's not like the world we're at is awful right now, but there's room for improvement. And the other thing is, you can just see we have got to take our own destiny into our own hands. I mean, we have to educate ourselves. We've got to learn all these things because, like we talk about so many times, guys, that's why I'm going to talk up Money Vikings Premium, because we are teaching all this stuff, and no one in school, well, maybe some people do, but most people I don't think learn all this stuff. And it's invaluable now. It's actually more valuable than some of the things we learn in school.
And what I cringe at is thinking that there are going to be the few that listen to this thinking nah, they don't know what they're talking about, right? And there will be probably that moment at some time in the future they realize I should have listened to these guys, because
we're trying to bring together all the ideas, right? And like you said, Bob, it's holistic. We're not just doing charting and swing trades. We're talking about everything here, long-term investments, budgeting, health, health insurance,
taxes, credit cards.
credit cards.
Yeah.
I mean, we study how millionaires became millionaires, and we basically display that. We just put that out there, like, hey, here's how they did it.
Here's
these are
their
the
habits. Yes.
habits.
And and the thing is that we will eventually be kind of putting out there is, okay, how can you improve on that? How can you do that better for the future us, where $1 million really isn't much anymore, right?
Well, once you make it there, you can go to the next goal.
Yeah. 100 million, 1 billion. Let's go.
Little known fact: most millionaires love the movies The Matrix. They like the whole franchise. Just so you know.
And the more millions you have, the more of them you like.
What kind of salary can you draw off $1 million with the 4% rule? It's like 40,000.
So it's 40,000. Yeah.
Yeah.
So it's 40,000. So that gives you a really good. Yeah, it's a great question, Jerry, because it gives you a good idea of what if you want that money to last like 30, 40 years, which retirements now can be. I mean, Bob and I, our grandfather was retired for 41 years, right, Bob?
I thought you were going to say you are grandfathers now.
Yes. My
Something you want to tell me?
children.
No, not that old. Not that old.
Yeah, our grandpa was retired
40
since 50. 50
Okay,
years
so
old.
and he lived to 91. So 41 years he was retired. So he had to fund a 41 years of. So it goes back to the history here. I think, don't quote me, but when Social Security was first set up, I think people collected on it for like 2 or 3 years. They retired at 65, and most people, I think, passed away at like 68 or 69. So
that's what the government wanted.
Well, that's
selfishly.
It worked. It worked. Yeah, it worked for the system at the time because you didn't have people on this thing. So that's why modern people have to be more strategic about this, because you could be funding 30 years. And we've talked about this, Jerry. Maybe the answer is, I know for me, maybe it is working longer. And if you find work you enjoy on some level, I don't think any job is going to be like perfect every day. But if you find something that you generally enjoy and you're learning, you're getting value, you like the people, you like the mission, I mean, why ever stop if you enjoy what you're doing every day? I mean, because it's a good thing to do. I mean, so people just have to ask themselves these questions. I mean, the other side of that, though, I realize, I mean, there's some jobs people can't do forever. You physically can't do them. I mean, try being a nurse for 50 years. I mean, the amount of physical labor, the toll, the mental health toll, especially now. There's all kinds of jobs like that where you can't do them when you're 60 like you did when you were 30. You just can't physically, or very few of us can.
Or even talk about physical labor jobs too, right? Masons and stuff like that, guys that are just constantly abusing their body day in and day out. Like, you can only do that for so long.
Yeah, you're not slinging rebar in the union job when you're 70 and you're like, I got another year left here. My knees will give out soon.
Right.
I mean, so it's, and that's why I think we really do. We're trying to throw out the strategies that would help anyone better themselves, no matter if they're white collar, blue collar, median salary, high salary. It doesn't matter to us.
No,
you can still apply these things. I've had everything in between. I've had low salaries, high salaries, middle salaries, and all through it, I've had different strategies to throw at wealth building. So just putting it out there.
Being adaptive.
Guys, what do we got cooking for next week? Any trade ideas or nothing? Hide and cover in a hole?
Bunker up.
Yeah, buckle up. No, I mean, I've put in a lot of hot trades over the past few weeks, and so there's nothing new that I'm looking at other than maybe a few earnings trades next week. I believe, I don't have the list in front of me. I think we've got Levi's. I think we've got Constellation Brands. They're all reporting earnings, and so anybody that's reporting earnings, I like, because of the high implied volatility. And the day before the earnings is announced, you can create a iron condor. You can sell an iron condor or sell a strangle. And we did that last week with Micron, and overnight made about $72 just doing one standard deviation out on the low side and the high side.
I think people need to understand, like, percentage wise, what is that? What was the percentage on that, Richard?
I don't have the percentage ROI on that off the top of my head. I'd have to take the buying power and then look at the profits. It's probably around 10 or 15. It's nothing astronomical, but
10-15% is astronomical. People need to understand 10-15%
it's wonderful.
overnight is amazing. So yeah.
Most people are losing money.
Yeah.
And then there is one other one that we put out to premium members without saying too much about it. If you look at the Russell 2000, we put in a trade that capitalizes on the channel or the range that it's been trading in for the last year.
Only for premium.
Only for premium is the trade, but the thinking behind it is to try and make the bet that it will continue trading in this range. It's skewed slightly bearish, but premium members know what I'm talking about.
Yeah. Bob, how about you?
I had spoken to this a while ago with premium members, is that I'm gonna start pivoting and shifting.
I'm gonna shiv it.
Yeah, pivot and shift with the shifting.
You heard it here first.
I'm gonna move in the direction of really starting to do a couple things. One, I want to start looking at trades that are going to take a period of time to draw out, but are going to be really worth the while for those to draw out. So medium to short term holds, not necessarily I'd say labeled as a swing trade, but
nice.
Little short term hold duration play, but also it's actually pivoting over to other things now because of the unsteadiness in the market. I am actually advocating for having a lot of cash on hand.
Yeah.
Being
I know.
Have pivot at your knees, because there's a lot of signs right now.
I know.
Last month in general, we're probably going to see a little bit of a spike up for a minute before we go back.
Yeah, Bob, I was thinking the same thing. I'm diversifying. I'm flowing to quality, and I'm getting more cash. Yeah. So I'm with you.
And the other thing to think about is, I have been thinking about a lot lately, is that when you get to a certain amount of money in your account, your trading account, it also may not be against you to actually withdraw some of that and maybe pivot over to real estate when the time is right.
Once Schiller says it softens.
Yes.
I've been doing that with Fundrise. I mean, ever since Greg turned me on to Fundrise, I literally took money out of my brokerage account and put some into Fundrise, and it has been doing well, and I'm happy with it. The last month especially surprised me.
That is awesome. Is it like 10% return?
Something like that. I think maybe a little more. But the last month has been good. So
you can't. I mean, there's nothing wrong with a 10% return.
No.
Nothing wrong with it.
No.
Yeah. Well, good stuff, guys. Great episode today. Thank you all for listening. Thank you all premium members. We will see you next week. Just remember, this episode was brought to you by The Matrix Resurrections and in theaters in December.
Arby's are us.
We'll have Keanu on next week, so please tune in. Keanu Reeves will be joining us. That's a lie. He won't really be joining us, so don't get upset. But we could act like Keanu. We also could do some Keanu impression.
Whoa.
Yeah, because he is really cool. I really like that guy, actually. Super cool guy. Hey, guys, great talking with you. Listeners, thank you so much. Have a great week, and we'll talk with you soon.
TMV, listen for 30% off.
There you go.